Hi folks, I'm Bob Benny,
I'm Jessie Thompson.
and we're both certified financial planner professionals, CFPs, with Bob Benny Wealth Management right here in Lincoln, Nebraska. And welcome to today's Bobcast. We try to do these Bobcasts every week.
We've fallen off of that a little bit lately, but we're doing our best.
Yeah, we're back on it. Anyway, what's the topic of today's Bobcast, Jess?
Today's Bobcast is health savings accounts, or HSAs. What are they and how do they work?
So, a health savings account is a tax-advantaged account for health expenses prior to age 65. Essentially, and it essentially operates like an IRA after 65 for non-health expenses. And that's the thing that a lot of people don't know about, is that it works like an IRA after 65 for non-health expenses.
That you can use it for whatever you want, but the money that you take out of it is taxable.
Right.
But after 65, there's no penalty for using the money for things that are not
Right.
health
Many
expenses.
people are familiar with them for at work. You know, they'll maybe have a health savings account that they can take some of their pay and have their pay go into pre-tax, and then they can use the health savings account money for out-of-pocket expenses. So let's talk about how health savings account work.
Yeah, so you can, as long as you have a high deductible health plan, whether it's through your employer, private, whatever, a high deductible health plan, you are allowed to contribute to HSA. This is nice because there's no income limitation, where there's some income limitations if you were to want to contribute to something like a Roth IRA or even a traditional IRA, depending on whether or not you're eligible for a work retirement plan. So that's something that's nice about it. So just so that you're aware, like the definition of a high deductible health plan, pretty much all health plans these days qualify as high deductible health plans. But for a single person, the minimum deductible is $1,700, or for a family, the deductible is $3,400. As a reminder, the deductible is what you have to pay before the insurance company starts chipping in and paying their percent. And then the out-of-pocket maximum, that's the most that you end up having to pay throughout a year if something catastrophic would have to happen to you. For a single person is $8,500, or for a family is $17,000. So if your health plan falls within those ranges, you're allowed to contribute to an HSA, and if your employer doesn't provide one, a lot of employers do not, you can open one yourself.
Right.
And so, go ahead.
I was just going to chip in that you do get a tax deduction just like a traditional IRA, right?
Right. So kind of the reason that we decided to do this Bobcast subject is because I've seen a lot of things lately talking about an HSA like it's some secret retirement hack or like savings hack. It's not really like that. There's advantages to it, and if you have the means to afford to be able to contribute to one and are eligible for it, we recommend that you do for a lot of people, mainly because of the tax deduction. But it's not some miracle savings vehicle. So you do get a tax deduction up front when you contribute to it. You can take out the money tax-free as long as you use it for health expenses. And kind of another like nice advantage about that is that there's no time limit on when the expense happened to when you can reimburse yourself for the health expense that you paid. As long as the contributions to the HSA were made before that expense happened, you could even reimburse yourself for those health expenses years down the line if you've kept all of your receipts. So all of that growth, like if you can just pay out of pocket for a health expense this year and keep your HSA growing, you could reimburse yourself for that health expense years down the line for, say, you want to go on a vacation or use the money for something else. As long as you've kept those receipts to back up, this is how much money I've spent on health expenses, relative to how much I've taken out of the HSA, you can kind of play around with that to let those earnings grow tax-free.
So what's the contribution limit?
The contribution limits for self-only coverage in a year is $4,400. If your whole family is covered, you can do $8,750 for a year. And the catch-up contribution, you can do an extra $1,000 if you're age 55 or over. So this is not going to be, it's not logical for this to be someone's probably main retirement account. And you're most likely, kind of the way that people spin it is that, oh, you could save all your receipts for all of your health expenses throughout all of your entire working career, basically, and then take all that money out tax-free in retirement to pay yourself back for the health expenses you had over your. Most people aren't going to have that many health expenses, and most people aren't going to be so diligent about keeping all of their receipts over their entire working career to be able to back up that amount of withdrawals. And you can't contribute, especially for a family, like you can't contribute that much money to it every year to make a ginormous difference, especially if you have like a couple in your family, if it's more than one person, in comparison to how much you can contribute to like a Roth IRA.
Kind of the neat thing about it that I think is that for people that are still working and starting or continuing in a HSA account, and say they're using that and they're making contributions and then they're making distributions to pay for out-of-pocket expenses through the years, and then some money has accumulated, let's say significant money has accumulated, and they reach age 65 and they go on Medicare, like I am now, and you have lower out-of-pocket expenses, may not even going to be using the large health savings account that you have, you can then turn that health savings account essentially into an IRA. Mm-hmm. and take distributions out of it and just pay taxes on it. If you use the distributions for medical expenses, they're tax-free. If they're not for medical expenses, they're taxable, just like your IRA is. So.
You can also use them, I believe, for Medicare premiums. I don't think you can use them for a Medicare supplement premium.
Right.
Don't hold me to that. Look that up. But I'm pretty sure you can use them for Medicare Part B premium to reimburse yourself for that. So that could be another advantage. So to kind of wrap that all up nicely, are HSAs useful? Yes. Do we recommend them if you're eligible and you have the extra money to be able to contribute to one and you need the tax deduction? Yes. Are they some kind of a miracle savings vehicle? No, they are not.
They're not a magic wand and going to make you solvent if you're not already on track for retirement.
Yep. So if you have any questions about health savings accounts or any other financial question that we can help you with, you know where to find us. You can call our office or you can email either of us at bob@bobbenny.com or jesse@bobbenny.com, and we'd be happy to help you. And make sure to like and subscribe so that other people can get the free education that we put out.
Thank you very much and have a blessed day.